Hi, I'm Andrew Berman from the Mortgage News Network, coming to you from the M&N Studios here in New York. You're watching Beyond Print, and with me today, I got my good friend Tom Lamalfa, president of TSL Consulting. Tom, thank you for joining us.
Andrew, my pleasure. Good to be back with you.
Always great actually to meet up with you. You know, you're, and I always kind of refer to you as like the kind of the crystal ball for the future in the mortgage business. You know, you have some great conversations, and many of them are formalized in the studies that you provide the industry. One of them, which is why you're joining us here today, is the study that you have based on your meetings at the Mortgage Bankers Convention that was just held in Washington, D.C. So can you take us back? Why did you originally create this survey?
The impetus behind the survey was my quest to understand better what the expectations were for the business and the industry. And having been in the industry for the better part of 40 years, I had a vehicle that was ready-made for doing a survey research project to ascertain those expectations and ideas from within the industry.
Great. So who participates in this survey?
Okay, I have a panel of experts, people that I have known through the industry for the better part of decades, who participate with me. They serve as the springboard or the panel that provides the responses to a series of questions that I develop between the secondary market conference, which is held every May, and the October MBA annual convention. And I set up meetings because all of us are in attendance at this particular conference and or convention. I set up meetings with people in advance, develop a questionnaire of important issues and topics within the industry, and then go at it to collect those attitudes, expectations, and ideas.
Fantastic. And what's the purpose of the survey? Like, what are you looking to get out of this? What are your clients looking to get out of it? And what does the industry get out of this altogether?
Sure. The expectation is that we will know more about market conditions and activity levels and trends within the industry. I'm trying to ascertain from all of the information that I look at on a day-to-day basis, what are the key factors that are going to affect the future of the industry? That's really what I'm after. And how those really changed over a period of time, since I do this twice a year and have done so for slightly more than a decade now.
Yeah, fantastic. So listen, Tom, and I know we're going to be publishing the results in National Mortgage Professional magazine on nationalmortgageprofessional.com. But you know, you've been generous enough to share some of the results here today. Can you please tell us some of your findings?
Sure, absolutely. Well, the first thing I want to tell you is that I'm actually dealing with 68 different issues and topics. That was the number of questions contained on this most recent survey. And of those, let me go through 20 or so that I think are the key findings. And I base that predicated largely on my perception of the industry and what was most meaningful to me. But if we look at those findings, the first thing I can tell you is that lenders expect interest rates to increase over the period between now and the end of next year. The expectation is that interest rates are going to rise about 50 basis points to the roughly 5.5% level from where we are today. So that's really one in terms of the expectations within the industry. A second expectation is that lower production is expected. We've seen it already this year, but it's expected to get worse over the near term. The current quarter and the first quarter of 2019 are expected to be very difficult, very challenging for the industry. Another one of the findings is that 2/3 of the loans that are being originated are conventional conforming agency, if you will, production. Another 25% of it is government insured business, predominantly FHA mortgages with a smattering of VA and rural in there. And that about 10%, the remaining 10% or so, are jumbo mortgages, mortgages that exceed the limits that Fannie and Freddie can purchase. So that's a sense of it. I can go through, if you'd like, all of the other findings as well, but I don't want to preclude you from raising any issues.
So now, I mean, I'm just curious. Listen, well, where does non-QM fit into that mix?
Non-QM is still a very small portion of what's being produced, but it's expected to increase next year. The slowdown in production is prompting more non-QM loans to come to the market, to be produced, more firms that are willing to originate that type of product. Also, I'm expecting to see an increase in FHA lending next year. So those two products in particular are likely to be hotter than they have been this past year.
Okay, so listen, and before we go into any more findings, tell us actually the most positive thing that you found out of this survey, because so far you told me, rates are going to go higher, production's going to go down. So just give us something actually positive that you got from this that maybe was even unexpected.
Well, there were a couple of things, actually, Andrew. One is that there is a high level of satisfaction with Fannie Mae and Freddie Mac. They appear to be hitting all of the right buttons with respect to the delivery of technology and the delivery of solutions, if you will, for low and moderate income borrowers. So they are geared up and ready to meet the production needs of originators. I would say that's the most positive thing that I heard.
That's fantastic. There are partners in this, so that's very important.
Yes, no doubt about it. But part and parcel of what we were talking about a moment ago is that we're going to see more risky mortgages originated, more mortgages with higher LTVs, higher DTIs, and probably lower credit scores in the 18 months or so ahead. So there is a connection there, a correlation, if you will, between moving into more FHA and non-QM production.
Sure.
One of the other things that it isn't necessarily so positive, but I did ask people about their finances, and the expectation is, while it's going to be a difficult 6 months, as I've suggested, we've got some blue sky likely to appear after that as a result. There's also some evidence of softening in home prices. I certainly see that in my market here. And in other areas, even on the West Coast, which is a big surprise. But this has just been unfolding in the last 90 days or so, that we're seeing a softening in home prices, which will be an improvement on affordability, which has been a major issue for the industry for some years now.
Fantastic. Great. Well, I mean, share if you have any other findings you want to share. I know. Actually, we don't want to give the full report here, but please, love hearing.
That I asked about is about the individual lenders and their finances, and what we're finding is that expenses across the board have been up, revenues are down, and so the next 6 months is going to be very difficult. And the major reason, for this is overcapacity within the industry. Lenders told me that there are 25% too many firms and too many loan officers, given the size of the production pie today. So that really explains why the level of competition in the marketplace is as high as it is, and also why margins are as thin as they are.
Yeah, which is the margin compression, which is what we saw through this week. There have been consolidations. Large lender locally here shut down. I mean, there's a lot of changes going on in the industry for people that are shaking out from this margin compression.
Yeah, I wish I could paint a more positive picture, but right now it really isn't that way. As you're suggesting, there's a lot of change in the industry. Everyone is telling me that they are reducing the size of their mortgage staff. and a lot of firms are looking for new partners. So I expect that the merger and acquisition activity is going to be rather brisk over the period ahead.
And did you get any feedback from the interviewees about mergers and acquisitions?
Well, I met with someone. I actually had lunch with a firm that just invested several tens of millions of dollars into a West Coast mortgage company. And then I had another conversation with someone who, back in May, sold his company. He's a bank that owned a mortgage company that sold the mortgage company. In part because of concern about what the future looked like, but also just the difficulty of managing the firm.
Sure. That's good timing. That's for sure.
Yeah, and there are others. There are clearly a number of firms that are looking to buy companies, and companies really are for sale now. What I'm seeing suggests that book value is about the extent to which buyers are willing to pay for mortgage companies.
So basically, they're just going to write a check so you can take whatever cash you have in the company out, and that's pretty much it. There's no multiples?
Yeah, no, not that I'm seeing. Small multiples, but generally not. I mean, to the extent that there are multiples, the cap seems to be about 1.5 book value, so 1.5 times, but that's less frequent given the number that are for sale today.
Yep. Understandable. Very cool. So any other findings that you would like to share with us?
Oh, wow. Yeah, there's really a whole bunch of things that I think are worth mentioning. One would be there's a good deal of criticism about Fannie and Freddie over their expansion. There has been concern for some time that Fannie and Freddie are moving into areas that are not secondary market related. Two of them come to mind immediately. One is the financing of MSRs that Fannie and Freddie have pilot programs for. Another is their debut through pilot programs into lender-paid mortgage insurance. Needless to say, banks are concerned about the former and mortgage insurance companies about the latter. And so it's worth pointing out that when I asked people about the constraints and what also was slowing production, I found that inventories was a big part of the answer. I gave them three options. They could talk about supply constraints that existed, about higher mortgage interest rates, and about affordability issues. And of the three, the lion's share pointed to thin inventories of homes that are for sale as being a retardant on production.
So any other findings you'd like to share?
Overall, there is a general feeling of satisfaction with this being a very good time for buyers to purchase homes. First-time buyers as well as trade-up buyers are thought to be in a relatively good position. The coasts are, of course, difficult because of affordability issues, but outside of the coasts, market affordability is generally good. Certainly that would be the case in my backyard in Cleveland, also in places like Pittsburgh and most of the Midwest. So it's probably a good time, according to lenders, for borrowers or would-be home buyers to act now. Lenders also overwhelmingly want to see the QM patch that was put into the QM regulation. They'd like to see that extended beyond 2021 when it is set to expire. That gives lenders more flexibility in terms of their debt-to-income ratio and would prevent it from being capped at the 43% level that was part of the original legislation or regulation, actually. So lenders would really like to see that. There is near universal acceptance of the need to reform the LO compensation rule.
Yeah.
That needs to be updated according to lenders. It's too constraining as it currently exists, and it needs to be revisited. There is a very interesting development that appears to be happening with respect to mortgage brokers and wholesalers. This is an issue I've been watching for lots of years, and lenders are now, because of the difficult and challenging economic environment in the mortgage arena, they are appearing to be readying and more wholesale business to develop. So that's an expectation that appears to be in greater demand or expected, much more so than had been the case. And so that's a relatively new development because the market for mortgage brokers has been quite small since the financial crisis. And I think the last thing I would mention is that would-be borrowers who qualify for a mortgage aren't being ignored. There's been a feeling among a lot of housing affordability advocates that lots of borrowers would like and would qualify for mortgages, but are being prevented from doing so as a result of tight credit conditions, and lenders are saying that's really not the case. So those would be among the major findings that I've seen. I would encourage people who want to know more about all of these subjects to take a look at the November issue of your publication, where they can read through the responses, the means, the medians, the averages, and the scores for all 68 questions, as well as get a better handle on the methodology behind who is participating in this study and why it's a pretty good reflection of the overall consensus within the industry.
Yeah. Great, fantastic. Listen, I appreciate all the work that you put into this study. You're, just setting up meetings with the top executives that you do. That has got to be an arduous task in itself. Creating the questions, and putting this all together. It is no simple task, and we just appreciate all the work that you do for the industry. We look forward to catching up with you again in the spring for the wrap up after the secondary.
Thank you. Appreciate the opportunity to share some of this, and I look forward to seeing the article.
Fantastic. I'm Andrew Berman from the Mortgage News Network. Thank you for watching.
This is Mortgage News Network.